Hello everyone. Welcome back to Nova Real Estate Solutions. I'm Dwight Morris, a certified divorce specialist at Innovation Properties in Fairfax, Virginia. Today I'm tackling an important question for divorcing homeowners in Northern Virginia. How does capital gains tax apply when selling your home during or after a divorce? If you're navigating this significant life transition and are concerned about the financial implications of selling your property, stick around. This video is packed with information you need. First, let's start with the basics. What exactly is capital gains tax? Simply put, it's the tax you pay on the profit, the capital gain, you make when you sell an asset. And for many of us, our home is our most significant asset. The IRS offers a substantial exclusion for homeowners when they sell their primary residence, which is fantastic news. But divorce can introduce complexities that need careful consideration. Let's break down the fundamentals. Normally, when you sell your primary residence, the place you've lived in as your main home, the IRS provides a significant capital gains tax exclusion, $250,000 for single filers and $500,000 for married couples when they file jointly. To qualify for these exclusions, there are rules you need to meet. The most important is the ownership and use test. You must have owned and lived in the home for at least 2 of the last 5 years before the sale. This doesn't have to be a continuous 2 years. Sounds straightforward, right? But here's where the intricacies of divorce in Virginia can affect things. Let's walk through 3 common scenarios I often see with divorcing homeowners in our area and how they typically impact capital gains taxes. If you and your spouse decide to sell your home while you are still legally married and filing your tax return jointly, you may qualify for the larger $500,000 capital gains exclusion. For example, let's say you purchased your home for $400,000, and due to market appreciation, you sell it for $900,000 while still married. Your profit is $500,000. In this scenario, your entire profit could potentially be tax-free at the federal level, thanks to the joint filer exclusion. When you file your taxes, this sale would be reported on your joint Form 1040. Of course, the division of the $500,000 in proceeds is a separate matter determined by your divorce settlement agreement. This is a very common situation in Virginia divorces. If one spouse is awarded the marital home as part of the divorce settlement and continues to live there, then later sells it as a single individual, they will likely be subject to the $250,000 capital gains exclusion for single filers, provided they meet the ownership and use test on their own. Here's a crucial point. The 2-year residency rule still applies to the selling spouse. However, under IRS Section 1041, the transfer of property between spouses incident to divorce is generally a non-taxable event. This means the spouse who receives the home essentially steps into the shoes of the original owners for the purpose of the holding period and cost basis. For example, let's suppose you and your spouse bought a home 5 years ago and then divorced, with your spouse remaining in the home. If they sell it 3 years after the divorce, they would likely meet the 2-year residency test. Let's say the original cost basis was $450,000 and they sell it for $850,000. Their profit is $400,000. As a single filer, they can exclude $250,000, potentially leaving $150,000 subject to capital gains tax. However, if they sold it only 1 year after the divorce and had not lived there for 2 years since the divorce, they might not qualify for the exclusion at all. meaning they would be taxed on the full $400,000 profit. Sometimes divorcing couples agree to continue co-owning the former marital home for a period after the divorce, perhaps to wait for better market conditions or until children finish school. When the home is eventually sold, the tax implications for each ex-spouse are considered individually. If both you and your ex-spouse meet the ownership and use test, meaning each of you lived in the home for at least 2 of the last 5 years leading up to the sale, each of you can claim the $250,000 capital gains exclusion on your share of the profit when you file your individual tax returns. Let's illustrate. You and your ex-spouse bought a home for $500,000 and sell it several years after the divorce for $1.1 million, resulting in a $600,000 profit. Assuming both of you meet the residency requirement, each of you is responsible for $300,000 of the profit. Each of you can then apply the $250,000 single filer exclusion, potentially leaving $50,000 taxable for each of you. Another incredibly important consideration that can significantly impact your capital gains tax liability is the cost basis of your home, and specifically the concept of stepped-up cost basis due to capital improvements. Your original cost basis is generally the price you paid for the home, plus certain closing costs. However, any capital improvements you made over the years can increase your basis, therefore reducing the profit when you sell. Think of capital improvements as enhancements that add value to your home, prolong its life, or adapt it to new uses. Examples include a new roof, a complete kitchen or bathroom remodel, adding a deck or patio, installing a new HVAC system, finishing a basement, or even adding solar panels. Routine maintenance like painting or landscaping generally doesn't count as a capital improvement. It is absolutely crucial to keep detailed records of all these renovations, including contracts, invoices, and payment receipts, along with the dates the improvements were made. This documentation can be invaluable when calculating your capital gains tax. For instance, if you bought your home for $400,000 and spent $80,000 on a major kitchen renovation, your adjusted cost basis becomes $480,000. The higher basis will reduce the taxable gain when you eventually sell. Now let's delve into timing and strategic planning, especially when you're navigating a divorce. The decisions you make now can have significant tax implications down the road. It's essential to work closely with both a tax professional and an experienced real estate expert here in Northern Virginia to evaluate your specific situation and understand your options. One key aspect is understanding the holding period of your home. If you owned and lived in the home for more than 1 year before selling, any taxable gain is generally taxed at the long-term capital gains rates, which are typically lower than your ordinary income tax rates. If you owned and lived in the home for 1 year or less, any gain is taxed as short-term capital gains at your ordinary income tax rate. When you're divorcing, consider the potential tax implications of different property settlement scenarios. For example, if one spouse receives the house with a lower original cost basis, they might face a larger potential capital gains tax liability when they eventually sell, compared to the spouse who receives assets with a higher basis. This is something to discuss and potentially factor into the overall asset division. A skilled tax advisor can help you project potential tax liabilities under different scenarios and advise on the most tax-efficient way to handle your real estate. They can also guide you on strategies like maximizing your capital gains exclusion and properly documenting your cost basis. Remember, getting professional advice early in the divorce process can potentially save you thousands of dollars in taxes. Divorce is undoubtedly a challenging time, both emotionally and financially. Understanding how capital gains tax applies to the sale of your home is a crucial part of making informed decisions that will impact your financial future. If you have specific questions related to your situation in Northern Virginia, please don't hesitate to reach out to a qualified tax professional or a real estate expert like myself. You can also leave a comment below with general questions. I'm here to help you navigate the real estate side of divorce with clarity, confidence, and a focus on your best financial outcome. Thank you for watching this discussion on capital gains tax for divorcing homeowners. Don't forget to like this video if you found it helpful, and be sure to subscribe for more valuable insights into Northern Virginia real estate and divorce. And please share it with anyone who might benefit from this information. Until next time, take care.